And now it's time to welcome our second guest, Anthony Saccaro. Anthony is the founder and president of Providence Financial and Insurance Services in Woodland Hills, California. He's been in the business for approximately 20 years and has twice been named one of California's top financial leaders by Forbes magazine. He's widely published author and a frequent guest on Fox Business News, CNBC, as well as other financial media. Anthony, welcome back to the show.
Hey, Dave, thank you for having me. Great to be here.
And of course, most importantly, I forgot to announce that you and I are actually in a study group together, and we're pretty good buds when it comes right down to it. So it's particularly my pleasure to have you here today. But I won't waste time on all the niceties, even though you are from the left coast, and people there tend to be a little nicer sometimes than us East Coasters. I want to get right to it because we've had a lot of newsworthy topics that we've had in the financial news so far this past week. So tell us, what do you make of all this market volatility that's occurred? What do you make of this so-called flattening yield curve that started really on Monday, December 3rd? Educate us.
Yeah, so I think there's a combination of dynamics that are kind of all coming to head at the same time, kind of like the perfect storm, if you will. You know, first of all, we're in record territory as far as this cyclical bull market is concerned. As of August last year, we've never had a cyclical bull market longer than we've had now. And just from a common sense standpoint, nothing goes up forever. We know that. Part of the reason why stocks have gone up, matter of fact, I'm going to argue that most of the reasons why stocks have gone up over the last couple of years especially has been artificial. I think if you go back 10 years ago, it started off artificially with quantitative easing, putting money in the system. That just messes with the normal cycles. And then the last couple of years, you've had stock buybacks that have created a demand for stocks that is completely artificial. And I think most people don't understand the effect that stock buybacks have had. And then you throw on top of that rising interest rates, and you've got all these things coming together, and it's just bound to lead to a stock market that's going to be ugly in 2019.
Yeah, a lot of these stock buybacks came from borrowed money, i.e. the issuance of more corporate bonds. But in light of all that, the rates have still stayed low in the corporate bond market, which is something I want to ask you about when we come back from the commercial break. So stay with us, Anthony, if you will, please. And you stay with us, too. We have a lot more here on the income generation from Dave Scranton and my good friend, Anthony Saccaro. We'll be right back. But now it's time to welcome back Anthony Saccaro from Providence Hills, California. Now, Anthony, I appreciate you giving me that factoid that we set a record for the longest cyclical bull market in August. Because I've been saying we're near a record somehow, but I've been dancing around that because I just haven't taken the time to look up. But you know that we've hit a record then as of October. So we are now in the longest cyclical bull market, or at least until the last couple weeks it seems, huh?
Yeah, that's exactly right. And we know that no good party lasts forever. Nothing goes straight up forever. Nothing goes straight down forever. And I think there's reason to be concerned.
So how much of your concern stems from the Fed? You know, I've had this concern that the Fed creates a lot of recessions, raising too much too quickly. Do you share that concern, or do you think there's other factors out there that are bigger than the Fed?
Well, there's certainly a lot of factors that are of consideration as well, too. The Fed certainly has a big paw in the sand bucket as well. But the reality is that the challenge is as the Federal Reserve starts to raise rates, it gives the stock market competition. With the interest rates being so low for so long, really investors have had nowhere else to go for yields. You could go get a 1 or 2 or 3% dividend somewhere else and do better than you could anywhere else. But with the 10-year Treasury, staying at 3% for the last couple of months and now dipping down below, it's given competition and certainly is going to affect the stock market if the Fed keeps raising rates.
So that's one way. One thing, of course, the flow of money out of stocks into interest-bearing investments. Now, those look more attractive. But how about the economy overall? We had 4.2% GDP in the last quarter. It was closer to 3.5%. You think we're going to maintain that, or do you believe that 2019 we're going to slip back down in that 2% range?
Yeah, I don't think that we can maintain that. That's certainly something that can happen quarter by quarter. And don't get me wrong, things are better than they were a decade ago for sure. But the reality is a lot of the numbers we hear are artificial themselves. Unemployment's not in the 3.7 range. That they don't count the millennials. They don't count people that have been unemployed, that are no longer getting a check. They don't count the baby boomers that want to work but can't. The consumer price index, that's not real. That's an artificial number. That doesn't count things like food. So
it sounds like you're questioning actually how the GDP is calculated in part also, which I'm going to ask you about more. We need to take another commercial break. So you need to leave it there for now. We'll be right back to ask you about that. And you stay with us, our Income Generation members. Dave Scranton and Anthony Saccaro will be right back on the Income Generation. Welcome back to the Income Generation. You're here with David Scranton and Anthony Saccaro. So Anthony, of course, man after my own heart, I know from our study group that, we're in agreement that the unemployment rate is truly understated when they factor in long-term unemployed people. And we're also a little skeptical of the GDP growth, the inflation numbers. And just this week, what do you make of the report just this week that came out where the Federal Reserve actually said that they believe that the inflation rate based on other factors is less than what's been published recently?
Well, essentially, the Federal Reserve just said what you and I have been talking about for the last 10 or 12 years that we've known each other, and that is that these numbers are artificial. And when it comes to the GDP, one of the things that's going to have a huge impact as far as moving forward is concerned is the interest rates rising, and from a level that we haven't talked about a lot, and that is that for every quarter point that the interest rate rises, it costs the government another $50 billion a year in interest because we're now $21 trillion in debt. And that's going to hurt GDP. They don't want to raise rates, but they're kind of stuck. They have to, but they can't. And the stock market's reacting to that.
Yeah, and the yield curve's flattening, which, as you and I've talked about all the time, is a big warning of a recession. But in the last minute and a half or so we have left, I want to focus more on individual investors, our Income Generation members, our viewers, those over the age of 50. What do they need to do to protect themselves in an environment like this?
Well, I think you want to be super careful, first of all, and knowledge is power. And most people that are over 50 have never invested in income-producing investments. It's all been growth and stocks and mutual funds. And if you're invested that way, but you need income, then you're forced to sell shares to get the income you need, and you cannibalize your portfolio. Hook up with someone that knows how to invest in income because it's a completely different strategy and philosophy than the way you've always done it.
So in other words, investing for the I, not the G, because sometimes you invest for the G for growth and you get L, you get losses. So in 30 seconds then, tell us how, you're out in California, you're on the opposite coast from me. How's that message? Is that message ringing in people's ears, or are they still struggling with it, or is the stock market volatility over the last couple months helping them absorb and accept that message?
Yeah, so most people that have been in the market over the last couple of years actually have had a hard time accepting that message. But anytime volatility picks up like it has, that message rings truer, and our phones are ringing off the hook because of what we've been telling them for the last couple of years.
Okay, so you're seeing it come around. All right, that's great. And it probably helps that you're over there on the left coast, and most of them agree with you that Trump's economic plan is not going to sustain that 4% GDP growth. And that makes them more conservative by nature. But we've got to run. Anthony, thank you once again for being part of the show. And you stay with us. We'll be right back here on the Income Generation. I'm David Scranton.